Forex trading. In this video I'm going to talk about what works and what does not work. Now let's start off with what does not work. Most of the material taught to retail traders does not work, and I'm including the material that's sold in training courses. I'm including most of what you read on the web. For example, technical analysis, standard technical analysis just doesn't work. Anybody who works in quantitative finance, who studies these things scientifically, will tell you this. The sort of indicators that are sold to the public, the MACD, the CCI, stochastics, etc., I regard all those as pretty worthless. Elliott wave, all sorts of cycles, including astro cycles, the sort of gurus that you see rolled out on Bloomberg. I've seen people base their trading plan based on something that they've watched on the TV. And all the newsletters, nearly all the newsletters that I read on the web, loads of nonsense, the Heidenberg indicators, all sorts of, some of it's quite bizarre. None of that stuff works, and anybody using those techniques will lose their money. I guarantee you that. Now, from time to time, I run into people who would passionately disagree with some of the controversial statements I've made there. But you know, one of the nice things about trading is it's a numbers game. So if somebody has a claim that something works, then all you got to ask them to do is prove it, right? You can open an account with, say, $500 and put the results up on an independent service like my FX book and generate a performance curve. And I've had this conversation with people who tell me they're convinced a certain type of technical analysis works, or that the third wave of the fifth Elliott wave always works, or some sort of astro cycle that when the full moon comes out the market always goes up. And whenever then I ask them to show me some performance to verify that claim, all you get is excuses, all sorts of sometimes bizarre excuses. The rule of thumb I use as a trader, I'm quite a skeptical guy at this stage, and the rule of thumb I use is if somebody cannot show a performance record, then that ought to tell you something. It tells you you don't have one. Now just think about that for a second. If someone can't show you a performance curve, if you know a guy who's very good at football or very good at golf and they have an excellent score, they're going to tell you what that score is, okay? If a guy tells you he's a star golfer and then you say to him, well, what's your handicap or what's your score? And he says, well, I'm not going to tell you, you know, that's a little bit odd, and that ought to tell you something. So the bottom line here for me, and I encourage you to adopt this approach as well, is if somebody can't show you performance, walk away. Okay, so given that, what does work then? So I'm sure all of you have heard of risk control and money management, and those things are very necessary but not sufficient. If all you've got is those two things which are widely taught, then all that means is you're going to go broke more slowly. I like to use the analogy to casino here. If you go into a casino with great risk control and great money management, you're still going to lose because the house has an edge. And it's the same with any trading methodology or systematic trading that you do. You've got to have a positive expectancy over time to make money. And the key to that in the long term is to understand what we call auction theory and price action. So to understand price action, you really need to understand who the participants in the market are. Now, for currencies, there's about at least 20 main banks involved in the currency markets. There's the central banks, which engage in manipulation. There's the hedge funds, there's large speculators, and most of you who are watching this video will be in the category of retail traders. Retail traders are actually a very, very small part of the market and don't really have a lot of effect, and this is especially so when you consider that most of the brokers book the retail traders' positions, so they don't actually see the market at all, so the effect is pretty limited. So most of the time the market's in a pretty choppy range with unclear boundaries, and within that range you've got it's mostly the banks who are driving most of the volume. They're day trading between each other, buying and selling money for their clients, and you've got some pretty big banks in there like Deutsche Bank, which can handle up to maybe as much as 20% of the euro volume. And then you've got some pretty smaller banks in there too, handling, to say, the more exotic currencies. And a huge amount of trading now is a huge percentage of trading is down to algos, also known as bots. Bots is short for robot. And I'm not going to get in what the different types of bots in the market are right now because we don't have time in this video. But just to mention some of them, you've got the semi-martingale grid systems, you've got the search and destroy bots, which are hunting for stops. You've got the trend catch bots on different time frames, which try and catch trends, and you've got scalping bots, which tend to be particularly active during the Asian session, for example. Now, I like to know how all these bots work, and I like to look for the patterns that these bots show in the market, because that gives you an idea of the processes that are in the background driving the price action. Now, the effect of all these trading methods and systems operating at the same time in the market is that most of the time, probably say 70-80% of the time, the bulls and the bears are fairly evenly matched, and the price action is stuck in what the market profile people call a rotation, which is basically the price goes up and down but doesn't really go a lot of places. Now, an analogy I like to use for this is something like football. When you have a team that's fairly evenly matched, what tends to happen is that the ball tends to spend a lot of time in the center of the pitch, and the longer the game goes on, the more of a sort of stalemate situation you get, and the more time the ball spends in the center. But this doesn't go on forever, because basically one of the things you got to understand about price is set at the margin. What I mean by that is if another time frame participant comes in and gives the market a push, it really kicks off a trending move. So, for example, to stick with the football analogy, the two teams are fairly evenly matched, but then you say a new player comes on and he changes the pace of the game. It's only a pretty marginal change in the game, but suddenly one team, either the bulls or the bear, gets the ball and the price goes towards the goal at the other end of the pitch. Now, it's very difficult to put numbers on this, but I would just give you a general rule of thumb. And what I mean by rule of thumb is just there's a very general rule that works some of the time and doesn't work other times. I would say, as a rule of thumb, about 20% of the time this happens, the market kicks off a trending move. And this is also driven by new information. So, for example, if new information comes out that the Fed is going to initiate a new round of quantitative easing, QE3, then you may get a trending move against the dollar. If news comes out about Greece is leaving the Eurozone, then you'll get a trending move in the euro. And as a trader, then it's very important to be attuned to this sort of information, and important to understand if the market gets new information and changes its bias and the currency starts to move. Now, I've put an example in this chart of that. It's sterling, and you can see here that the market in this region was in a consolidation, what the market profile people call a rotation. Then new information came out and the market changed its bias, and the market started trending down. Then it trended down into a new consolidation zone. Some big players, you can be sure some bank or whatever, came in and ran the stops here and then kicked off a trending move down again. So that's an example of the market changes its bias and it's no longer in rotation and it starts a trending move. Now, just while we're on the subject of rules of thumb and Forex, let me give you a few of the rules of thumb I use. What you tend to find is Thursday and Friday tend to be the big news days. For example, the European Central Bank, the UK Central Bank meet on Thursday, and also, for example, on Friday you often get a big news announcement out of the States, like non-farm payrolls, and you'll often find the news in those days can cause the market to move. Sometimes it does, and sometimes it doesn't. You certainly get a move if the news surprises the market and the market hasn't priced it in. So on those days when I'm trading, I'm looking for breakouts and trends and trying to catch those. Then after that move has happened and a lot of the people who are on the wrong side of the market have gotten blown out, you tend to find Mondays a relatively quiet day in comparison. and very often then on Tuesday and Wednesday they're more likely to be turnaround days when the market retraces some of those big moves it's on a Thursday or a Friday. Now on Forex, a typical move on the majors is usually less than 150 pips a day, and that's a typical sort of move over the last 10 years. If you get surprising news where the market really changes its bias, you can see moves of over 200 pips. Some like the Aussie dollar, I've seen moves on pairs like that are quite volatile of 300 pips in one day. But typically 150 pips is good benchmarking. That sort of information is important, because if you've got a position on those and you've moved 150 pips that day, it's usually a good idea to book the profit, because next week you're going to get some retracement of that move. Just as a very, very general rule. Okay, this video is getting a little bit long now, so I'll start summing up. Successful trading is all about learning how to read and anticipate price action. The background to that is it's important to understand the drivers of the price action. This is what allows you to get an edge in the market. It's what I call the generator of the edge. Understand why you're making money, what advantages you have that allow you to beat the other traders in the markets. Understanding the price action really allows you to make directional bets with a degree of success. It allows you to make more money than you lose when you're wrong. Okay everybody, I hope you enjoyed this, and thanks for listening.